Today, we're tackling the financial question that's dominating every serious investor's mind: Bitcoin versus gold. The stakes have never been higher. For the last 2 years, the Federal Reserve has been fighting a relentless battle against inflation. But what happens when the Fed inevitably throws in the towel? When the economic pain gets too deep and the Federal Reserve blinks, pivoting from fighting inflation to fighting recession? Will gold, the 5,000-year-old store of value, reclaim its throne as the ultimate safe haven, or will Bitcoin, the new age digital disruptor, finally prove its mettle as the superior hedge against fiat debasement? Stick around, because we're breaking down the data, the history, and the macro playbook to tell you exactly which asset is poised to deliver generational wealth in the next economic cycle. To understand which asset wins, we first need to define the trigger, the Fed blink. In simple terms, a Fed blink, or a monetary policy pivot, is a reversal of the central bank's current course. Right now, the Fed is in a tightening cycle. They are raising interest rates to slow the economy and bring inflation down to their 2% target. This is a hawkish stance. A blink, or pivot, is the transition to a dovish stance, cutting interest rates and potentially resuming quantitative easing, QE, which is essentially printing money. Historically, the Fed only pivots when either a recession becomes unavoidable, or a financial crisis threatens the stability of the system. What does this mean for your portfolio? When the Fed starts cutting rates, two major things happen. The US dollar, USD, weakens. Lower rates make the dollar less attractive to hold, often leading to dollar depreciation. Liquidity surges. The money supply increases, leading to a general rise in asset prices, and crucially, reigniting the very inflation the Fed was trying to fight. This, my friends, is the exact environment where an inflation hedge is designed to thrive. The question is, who handles the heat better, gold or Bitcoin? Gold has been the world's default store of value for millennia. It is the original hedge against the folly of kings, governments, and, yes, central bankers. The case for gold rests on 3 pillars: scarcity, tangibility, and institutional acceptance. 1. Proven scarcity. Gold's supply growth rate, mined from the earth, is relatively stable, historically around 1.5% per year. This geological scarcity is gold's inherent strength. Central banks can't simply print it into existence, making it a natural counterbalance to fiat currency debasement. 2. Historical performance. Gold thrives on real interest rates. Real rates are the nominal interest rate minus the inflation rate. When the Fed pivots and starts cutting rates while inflation remains sticky, a stagflation-like scenario, real rates often plunge into negative territory. This is gold's sweet spot. Holding gold, which pays no yield, becomes more attractive than holding bonds or cash, which pay a negative real yield. Historically, during periods of extreme monetary easing and crisis, gold has been a powerhouse, often setting new all-time highs. Central banks themselves are buying record amounts of gold right now, anticipating this very scenario. 3. Safety and liquidity. Gold is universally accepted and highly liquid, especially through instruments like gold ETFs, exchange-traded funds. It has an established regulatory framework and a long track record of preserving wealth through wars, depressions, and currency collapses. It is the ultimate safe haven asset. The argument against gold, however, is its gravity. With a market capitalization in the multi-trillions of dollars, it requires monumental capital flows to move the needle significantly. It is a slow, steady ship. In an era of unprecedented digital disruption, some investors feel gold is simply too heavy and too slow to capture the explosive upside of a modern monetary pivot. Now, let's look at Bitcoin. Proponents call it digital gold, arguing it improves upon gold's core value proposition with a modern, digital twist. The case for Bitcoin rests on absolute scarcity, decentralization, and asymmetric upside. 1. Absolute scarcity. Unlike gold, whose supply can technically increase if a large, new deposit is found, Bitcoin's supply is mathematically fixed at 21 million coins. No central authority, no government, and no single person can change this. Its supply growth is predetermined, decreasing dramatically every 4 years in an event called the halving. This makes it the most perfectly scarce asset in human history, a superior inflation hedge by design. 2. Decentralization. Bitcoin is independent of any government or central bank. This decentralization is the ultimate hedge against sovereign risk. When a government defaults, confiscates assets, or prints its currency into oblivion, Bitcoin offers a censorship-resistant, borderless alternative. When the Fed blinks because trust in the system is breaking down, Bitcoin is the natural beneficiary. 3. Asymmetric upside. Growth hedge hybrid. Bitcoin is a young asset. While its current market cap is still a fraction of gold's, its relative size means that smaller inflows of capital can lead to exponentially larger price movements. When the massive waves of liquidity from a dovish Fed pivot hit the markets, the percentage increase in Bitcoin's price has historically dwarfed that of gold. In the last year, Bitcoin has doubled and tripled gold's return percentage, even as gold soared to new records. This is why many investors treat Bitcoin as a growth asset turned hedge. It offers a defensive posture with aggressive growth potential. The challenge for Bitcoin, as the search results confirm, is its volatility and its evolving correlation. While its long-term correlation to the S&P 500 is relatively low, in moments of extreme market uncertainty or a sudden crash, like a mini financial crisis that triggers the Fed pivot, Bitcoin has sometimes sold off alongside growth stocks, acting more like a high-beta tech asset than a safe haven. This is its current Achilles heel. So, which hedge wins? The answer is nuanced, but clear. Gold is the hedge against the crisis. It's the stable bedrock in your portfolio that protects your principal when the financial system shudders and the Fed is forced to change course. Bitcoin is the hedge against the monetary response. It's the dynamic, high-octane asset that delivers superior returns as trillions in new liquidity flood the system and investors lose faith in the dollar. Ultimately, the wisest strategy in this unprecedented cycle is a barbell strategy, a foundational, larger allocation to gold for genuine crisis protection and low correlation, balanced by a smaller, high-conviction allocation to Bitcoin for the asymmetric upside driven by its superior digital scarcity. Don't choose between the old and the new. Use the strengths of both to hedge against a blinking Fed and the new inflationary cycle. Now, I want to hear from you. Are you stacking gold, buying the Bitcoin dip, or using a combination of both? Let me know your current allocation strategy in the comments below. If you found this analysis helpful, smash that like button, subscribe for more in-depth macro breakdowns, and click the bell so you don't miss our next video.